This is Propulsion, the financial professional's catalyst to exponential growth. Are you a driven and ambitious financial professional, but you are finding it hard to break through to the next level? Or are you struggling to build and run your practice successfully? Join Francois Dutoy, a leading consultant and trainer, as he interviews not only the experts, but also people you have never heard of before, but who have done amazing things, about how they run their practices, the challenges they face, how they overcome those challenges, their failures, which tech has improved their business, how their revenue models work, and other practical aspects. We go deep so you can learn as much as possible. And here is your host, Francois Dutoy.
So in today's episode, I'm very excited to speak to a man that I've wanted to speak to for a long time. And the very first time I asked him if he was willing to come on the show, he immediately said yes. And I was very excited, and then took some time for me to set it up. And he was also overseas in the meantime. But this morning, I have the privilege to speak to Hugo van Zyl. So Hugo is an experienced trainer, lecturer, and the go-to industry specialist when it comes to all things tax migration, financial immigration, and all these words that we throw around that does not really exist sometimes. But I'm very excited to have Hugo here. Just some background on Hugo. So Hugo is a chartered accountant. He's also a tax and estate practitioner, and also a master tax practitioner. And I'm going to ask Hugo, welcome. I'm very happy to have you here this morning, and if you can give us some more background. Thank you.
Thanks a million. Yes, I'm, as you mentioned, a chartered accountant. My life changed exponentially in 1993 when Chris Hani was killed. My business partner, I became a partner 1st of March. Chris Hani was killed 29th of March. On the 1st of May, my business partner was in America, and I owned an audit practice, and I hated audit every minute of it. And then as the country changed, people were leaving the country, and tax and exchange control became the issue. My business partner left me with the audit firm and said, you pay me when you can pay me. And that was my first financial immigration client. Although Francois will know I hate that word. The real word is formal immigration. So he was the trial and error client, my own business partner. And since then, I have been doing formal immigrations then for, what is it now, 15, 20 years. And so I've been in this industry quite a long time. The things have changed over the years. So in 1993, 94, it was mainly Afrikaans people packing for Perth. Then came 94, 96, and it was my more, if I can call them with great respect, my Jewish community. In 2003, 2004, we had tax amnesty and exchange control amnesty to help people to clear up their foreign funds that they built up over the years. And lo and behold, over 67% of the 1,200 applicants was black. So the point I want to make is cross-border tax and exchange control doesn't know creed, color, religion. It is for everyone because it's the lifestyle of the millennial. No one is tied down to South Africa. We can always come back. We have a constitutional right to come back. So the first thing I want to say, Francois, is that whatever we discuss today, there is no requirement and no need to give up your South African passport. And if you're applying for dual nationality, not my field of expertise, but do make sure you get permission to have dual nationality so that you can retain your South African passport. Nothing of what we discussed today will impact on your right to retain your South African ID and South African passport.
I think that's such an important point, Hugo, because you know a lot of people think, and I've got somebody that I've been talking to that's currently in America, and it is a case of like they want to give up their South African citizenship, and according to me, that is not necessarily the case. But is there any countries that would, in fact, if you want to move there and you want to become a citizen there, that they would insist on you giving up your other citizenship?
No, not America. There's one or two countries in the world where we've seen that initially. Namibia was one close to us. So we have some South Africans with Namibian passports that gave up their nationality, South African nationality. Subsequently, there was a court case in Namibia, and they now allow dual nationality. Denmark, Germany are still countries which dislikes dual nationality. Do remember, again, not my expertise, but I work closely with a law firm in London called Breitenbach's, very South African firm, and you are entitled to give up your passport and retain your South African ID. Just to give you an example, we've recently had someone who came back to South Africa, lived in Germany, and when he applied for a work permit, the South African government came back and said, as you were born in Walvis Bay in the days when Walvis Bay was still South African territory, you're with your South African ID book and read national, so you could vote. His wife came in and she was German. She then got the non-citizen spousal one. So if you were born in South Africa, we have a very strong constitutional right, and government has no hesitation in issuing you with the correct ID.
Oh, that was very interesting. So it just shows you that I think there's so much myth going around about like you have to do this, and it means that if you leave here, you need to leave unconditionally and leave everything behind and cut your ties with South Africa, and that is
not the case. Problem is that, Francois, that because a lot of the scaremongering articles refer to South Africans working abroad, and our tax law does not refer to South Africans. It is very important to understand tax law refers to the word resident, and a tax resident can be someone who holds no South African permit. So it's someone who comes into South Africa every year for 183 days, our swallow. They are indeed able to become tax resident in South Africa, and they have no permit other than the annual visitor's permit that they apply for before they arrive. So we do not tax based on nationality and citizenship. It's purely on that definition in the Tax Act, resident. And we're going to keep on coming back to that today.
Yes, absolutely. So let's start off with a brief overview. I think I said to you before the interview that if somebody doesn't know yet about the change, I don't know, they've been living under a rock. But just for the audience, just a very brief summary of the changes in Section 10 that's happening in terms of where previously, if you lived or if you worked outside South Africa for 183 days, at least in the tax year, and then also that requirement to be out 60 days continuously, etc. So can you just clarify that, and then just the new changes in terms of the R1 million cap that comes in, and maybe the issues around that?
Right. So I'm going to go a little bit back to basics, because there may be just someone who have heard about it, but they don't understand the context because they don't come from the tax specialist background that I come from.
Yes.
So first of all, Section 10, where this capped exemption, it was a total exemption that has now been capped. And that is in the Tax Act, where it deals with gross income, okay? And that means you must be tax resident to claim a Section 10 benefit. So very, very important. You must be a tax resident before you even look at Section 10, which means you are taxed on gross income, which is a worldwide test, okay? Then secondly, we must remember that the part that was changed is Section 10.10 and then Roman 2. Okay, 10.10 Roman 2. So 10.10 has separate subdivisions. Okay, and it's only the one part that was changed. So for the seafarers and the people that are working on a South African ship, your laws did not change. Okay, so if you qualify as crew on a ship, you may have a completely different set of rules. Okay, so in 10.10 for all the other people, it has changed to the extent that previously, if you complied with 183 days in any 12 months, then you were totally tax exempt on, and I use the word remuneration, but it's important to understand that in Section 10.10, it has its own definition of remuneration. So it's not exactly the definition that we find in the Schedule 4, which deals with pay as you earn. So for remuneration, we have to look at 10.10's 2's definition. I'll come back to that later. So very important now is that in future, that amount that was previously exempt was all the days that you were outside of South Africa. So if you worked in South Africa 9 months of the year and you were in South Africa 3 months, they always had the right to tax the 3 months. No change there. That 9 months that was tax exempt, completely tax exempt, that now is capped at R1 million. So for those people, let's use the people living in Dubai, they're out of the country 12 months of the year. They always paid no tax in South Africa because they had no working days in South Africa. When they were in South Africa, they were on leave, Easter and Christmas. And when you're not doing any work in South Africa, SARS will not tax you on the days in South Africa. So that days that they tax in South Africa must be working days. Very important. Okay. So what now happens is that that exempt amount is now capped at R1 million, which was a very low amount. And so there's some history. It was initially not capped. Then there was a strong lobbying group by the TPG, but they were quite successful in bringing in that R1 million exemption. tax petition group, TPG. They also, together with, I think, Saika and Sahit, where I was part of the team that went to Parliament, succeeded in having it deferred. So now the law has been amended. It is law. It is just the implementation or effective date, which is 1 March 2020. So it's February 2021 tax year, but everybody is referring it to tax 2020 or expat tax 2020 because of the 1 March, the implementation date. So this 1 million exemption is not new. South Africa just copycat from America. In America, the exemption at the moment, similar rules to ours. They just don't have the 60-day rule. They have the 183-day rule. And theirs is 183 in a tax year, which is a calendar year. Ours is 183 days in any 12 months. And their cap is $106,000. That's exempt. The other part that very few people refer to, and it was not exactly simultaneous, but at this, I think right about the same time, but probably a year beforehand, Section 6 Quat was amended to say that to the extent that certain amounts are exempted, the tax dealing with that exempt amount must be thrown away. So remember, we have a Section 6 Quat before we get to any treaty that says unilaterally, South Africa on any income taxed in South Africa from a foreign source, very important, from a foreign source. So if you're working in Germany, your source is normally where you do your work, where you execute your labor. Then the tax that you pay on that foreign sourced income, tax in South Africa because you're tax resident, you can claim a tax credit before we go to the treaty in terms of Section 6 Quat. But because let's say you earn 3 million Rand, 1 million of that is exempt. Now SARS says in 6 Quat, the unilateral tax credit rule says you will only get 2/3 of your tax credit. So only 2/3 of the German tax you paid will be deducted in South Africa as a tax credit. So that is roughly the changes.
Yes, so if I can interrupt there quickly. So that is just simply because of the fact that the first million is in fact already exempt. So you can't claim tax on the full amount if you already didn't pay tax on a third on it in South Africa.
Yes, and that's it. We've had that rule for many years in 6 Quat in a different format. It just said, for example, if you paid, I'm going to use a practical example. If you forgot to tell the Americans that you are tax resident in South Africa, they withheld 30% foreign dividends tax on your American shares. South Africa's only going to give you credit for 20%. The extra 10%, you must go and claim from the Americans. South Africa will not use that additional 10% as a credit against your South African sourced income.
That's very interesting. All right, so that's the background on this, and maybe one thing that we can touch on is like when you are working outside of South Africa, there's a specific definition around what constitutes South African territory.
Yeah,
can you maybe just allude on that a little bit?
Yeah, so that includes South Africa and then the territorial waters around South Africa. So it goes about 50 kilometers into territorial water. But the minute you cross the Botswana border, you're outside of South Africa. So it's very important that you understand that someone who's on a fishing trailer that just goes into South Africa, stays in South African water and fish, they then cannot claim this because they're not leaving South Africa. Okay. And also very interesting is for the seafarers and the crew on board a ship, there's no 60-day test. As long as they're out of the country 183 days, they will be totally exempt. So let's use an example of a person that's on the MSC Symphonia. He works and they are in South African territory for about 4 to 5 months a year. If that's the boat that you were employed for the entire year and for the period that 7 to 8 months that it was not in South African waters, you were fully employed and on board that ship as crew, okay? Not as the entertainer, not as the auctioneer, as crew. Then you will be tax exempt even on the days that you were in South African waters. That is not true for other employees. So for example, if you work for an oil company and you're based in the Netherlands because the head office is in the Netherlands, they send you to South Africa to come and work here or attend board meetings and a total 60 days of the tax year, you're going to pay tax 60 divided by 365 multiplied by your annual global salary.
So I want to, with that as an intro, get into this whole thing. And you mentioned it earlier, there's a certain word that you hate. And I mean, initially when we started doing a lot of research around the changes and what's going to happen and what are the impacts and that, we sort of came across this thing called financial immigration, and there's certain people that's pushing hard for financial immigration. And most people think that if I want to not pay tax in South Africa as well on the income from, and that's the other thing, it's only on, this exemption only applies to income from employment. So as you said, remuneration, and that if they then financially immigrate, that they are then home free, they don't have to worry. And so I want to get into this whole financial immigration that does not really exist. And, what is it really about? What are the things that they need to look out for? So if we can get into that, Hugo.
Yeah. So I know that some of the people listening in today probably follows me on LinkedIn. So let's, cut the chase and be honest. So there's two groups in the country. One being myself. My brand name is Tax Migration. That's also my webpage, Tax Migration. There is no such a word in tax law. It is a word I created. So that a specific group selling formal immigration created a brand which they very controversially promoted as saying financial immigration, meaning formal immigration. They then went out on the industry, lots of articles stating that the minute that you have completed formal immigration, you have notified SARS and Reserve Bank that you are non-resident, and then you are no longer ordinarily resident in South Africa. So first of all, they focused only on the ordinarily resident test. That is not true. And at one stage, they even threatened me with an interdict. And I then went to SARS through my professional body and said, you cannot allow people to continue telling the world that formal immigration sorts out your tax position. And now if you go to my webpage, you will see I link you to the SARS page. SARS categorically states financial immigration does normally have no impact on your tax status, because when you do formal immigration, you have probably and should have, in 99% of the cases, you should have completed your tax immigration or tax exit. So tax immigration is my word. The word used in Section 9HA of the Income Tax Act says cessation of resident status. Cessation of resident status. I then refer to it as exit, as most other people do, and I sometimes use the word tax migration or tax immigration, and I'm first to admit, it's my word, it's my brand. It's not in tax law. But what I mean with that is when you terminate, and Section 9H says, if you cease to be a resident, you are deemed to have sold your assets to yourself at market value the day before you cease to be tax resident. The reason why it's day before, because then you're still a resident and SARS can grab you. There's a technical reason. There was a trade hold court case which forced them to make that amendment. But now Section 9HA must be read with Section 1. And that is where the people punting formal immigration as a tax immigration, I think, lost the plot, with great respect. Tax resident, and I'm going to quickly jump into that so that we can get that one out of the way. Tax resident has two components. It is either someone who is ordinarily resident in South Africa, and there's a lot of tests. The other one is someone who is physically present in South Africa, and I'm going to briefly give it. It's very complex, but for someone who comes to South Africa on a work permit, it takes roughly 6 years to become tax resident on the physical presence test. You must be in the country for 5 years consecutively, and you'll only become tax resident in the 6th year. So you need 6 consecutive years of 91 days. At the end of the 5th year, you do the test, and you must have been in the country an aggregate of 915 days, 915. If you divide 915 by 5, you get 183. So your sub minimum is 91, and your aggregate must be 183 per tax year average. But it could be that in 1 year you're 92, and the next year you are 365. When you then look at the word resident, it then has an exclusion that says, and you will not be resident if you are 330 consecutive days out of South Africa. But that proviso, as we call it to the Tax Act, that proviso of 330 only refers to someone who became tax resident because of physical presence. So the 330 test, which are sold to so many people, that have been in Dubai for full year, more than 330 days, not applicable to most born South Africans or anyone with a South African passport. Okay, 330 days is for someone who came in on a work permit or a spousal permit on average. Maybe a few exceptions, but default is 330 days. Forget that if you're South African.
Sorry, if I might just jump in quickly. So that is mainly because of the ordinary residence test. Because if you're going to return home, even if it's 40 years from now, you're still ordinarily resident.
Correct. And that is where I highlighted to SARS, and they did not put that in their webpage, which is a pity. But if you go to the interpretation note on ordinary resident, they make it very clear that if you have no other passport, no other visa, and they also refer to if you were seconded, and even if you then spent no days in South Africa for 1 or 2 years, they still treat you as ordinarily resident because your intention, one, is to come back. Your ability is you can only come back. And then also on the fact that at the end of all your journeys, you are forced to retire to South Africa. So although we don't tax on a nationality basis, one of the things that one has to consider is your ability to not return to South Africa. Okay. So that was that ability not to return that I think a lot of people abuse in the formal immigration, because in formal immigration, you undertake not to come back for 5 years. It's not for every day. It's only 5 years. Okay. And nothing stops you coming back to visit South Africa. So very important. You're so correct, Francois. It is, we must look at it in context. And then also when it comes to ordinarily resident, we must assume, I think the default is very safe, that if you're a South African and you are working abroad in a country where you have a short-term work permit, like Dubai, like Saudi, you probably ordinarily resident in South Africa because you are going to return to South Africa, or you're probably forced to return. But luckily for us, and that's the great news of today, is there's the last provision, and this provision deals with either ordinary resident or anyone that was physically present for 915 days in a 5-year cycle. The Tax Act says, but excluded from the word resident, because remember the word tax resident is again not defined, it's just the word resident. We use the word tax resident, but excluded from the definition of resident is anyone who is deemed to be solely resident of a treaty country in terms of that treaty. So you may indeed be ordinarily resident, but treaty non-resident. And that's where the big solution lies for most South Africans. Everybody who lives in Saudi, who lives in United Arab Emirates, Dubai, Abu Dhabi, they are entitled to say, I am ordinarily resident. I admit I'm coming back to South Africa. I'm not even denying it. But because if I look at the double tax treaty with the UAE, in terms of the treaty, I am solely tax resident in United Arab Emirates. Therefore, I'm able to seize my tax residency status in South Africa. It could be costly because remember, so very important is a lot of people want to just tax immigrate or exit their tax and say, now I am no longer resident. But SARS is very clever. They say to you, we're quite happy to release you as a resident, but before we release you, we want to have 18%, that's the capital gains tax rate, on all your unrealized gains worldwide, with a few exceptions. The biggest exception is your immovable property title deeds in your own name in South Africa. They will only be taxed when you physically sell them, and your South African retirement funds, retirement annuities, provident funds, pension funds. That's very important. I just want to quickly add this, Francois. So just to bring back what I said earlier about Section 10 falls into the resident rules. So by breaking the word resident, by falling within that exception that you're now solely tax resident in a treaty country, you're no longer subject to Section 10. So therefore, your exemption is all income outside of South African source.
So we talk about double taxation agreements or double taxation treaty. They are in fact the same thing. What is very important is that each and every country's DTA that they've got, a double taxation treaty that they have with South Africa or that South Africa have with them, is in fact different. There is no, because a lot of times people talk about a double taxation agreement as if there's only one that exists, and as long as there is one, you'll be fine. But people need to realize that you need to go and look at the agreement that's in place with the specific country where you are working in order to see what that agreement entails and how it works. Although the concepts are the same in most of the agreements, there are actually differences with the different countries. So the question, if we're then going to talk about UAE now, is like, so how does somebody now, and this is just a question I wanted to add, is what is important is that when you've bought property overseas, the CGT when you exit will be on that property, but not the
correct.
property that's in
Absolutely
South
correct.
Africa. So sometimes people forget about, they just think it's on their things in South Africa. It's actually on their worldwide assets, just excluding South African immovable property.
Correct, yeah.
Cool. So let's talk about UAE.
If we then look at the treaties.
Yes.
Right. So very important, we must understand, and SARS also refers to that in the interpretation note, I think number 3, dealing with residence basis, that the treaties are considered, the definitions in the treaty seems to override South African law. They're actually in parity, but SARS tend to allow them to override the South African law. So quite interesting is that one of the, and we later going to have a question about Zambia. If you look at the Zambian treaty, you can only apply the Zambian treaty if you're ordinarily resident in Zambia. So anyone who's resident in Zambia based on the physical presence test in Zambia is out of the system. They cannot avail to the treaty. So although our law says you're resident because of the fact that you are in South Africa more than 915 days, if you become resident on the physical presence test and you now go and you work in Zambia, sadly for you, you can't use the Zambian treaty. You must be ordinarily resident in South Africa or Zambia before you can use the treaty. Interestingly, if we look at, as a comparison, the United Arab Emirates, you only need to be resident or domiciled. Only resident or domiciled. If you then look at the Malta Treaty, it says you must be resident, you must be domiciled, either one, and you must pay tax on worldwide income. So you must pay tax before you can claim the benefits in the Malta Treaty. The UAE Treaty has no such a provision. Okay, we don't know. It was negotiated in the capture area. So was that the reason why it doesn't refer to it? We don't know, but it stands at the moment. Also, treaties needs 18 months notification and then normally 2 years of implementation. So there's a risk. There's always a risk that they can change the treaty. We have seen protocol updates with America, UK, Australia. So they can update the treaty, but there will be a notice period. So at the moment, the treaty has been there since negotiated 2015, and that's United Arab Emirates, came into being in 2016, and there's no notice from either country to change that. United Arab Emirates then have issued a letter to the OECD, and they have 2 systems. You are resident, tax resident in the United Arab Emirates the minute you have a valid lease agreement and a valid Emirates ID, EID. That's all. No counting of days. You must have that ID, so the visa to work, and you must have a lease agreement. Okay. So interesting, they refer in the document to an Ajari lease, but that word is unique to Dubai. I think in Abu Dhabi, they refer it to a Turek. But anyway, what it means is it is a lease agreement registered with government. A very interesting country. They don't really have courts like we have. They have peace officers that can make judgments. And if you have a dispute with your landlord, there's a specific, the Ajari system will deal with it. That's what it means, Ajari. It's just registered with government. If you don't have a lease agreement, then you have to have what they call an NOC, notice of no objection. Okay. And that is for the pilots working for Emirates and Etihad in Abu Dhabi. They live in apartments given to them by the sheikh. Okay. So because the sheikhs run the airlines, it's government. Remember, the sheikhs are government. And then they have what they call NOCs. So that's a letter that there's no objection to them staying there. They don't have lease agreements. They stay for nothing. But you see the big problem there because there's a fringe benefit already coming in.
Yes.
But anyway, now back to the treaty. So then in terms of their own law, and it's always so funny when I go to Dubai, I've just come back from my 3rd trip for this year, they Treasury, which we call treasury.gov, and I think that is why Trevor Manuel those days changed our name. So although he's the Minister of Finance, the Treasury's webpage is called Treasury. In Dubai and Abu Dhabi, the webpage is called MOF, Minister of Finance. So it's mof.gov.ae for Arab Emirates. And then you must remember to put the /E in. And then they say you're tax domiciled if you add 3 more criteria, sometimes a 4th one. The first, so remember now you must have the ID. Secondly, you must have the lease agreement. maybe fourth one, some people see it as an extra requirement, but it is just to get their tax domicile. So they don't give you a residency certificate, they give you a domicile certificate. You also need to give your copy of your passport and the visa that's stamped into your passport. So they want the EID, that's the electronic card, like our smart ID, and they want the actual visa. Then the next requirement is you must have a bank account of 6 months. You must have an entry-exit report that shows that you've been in the country either 180 days consecutively or 183 days in any 12 months. If you can't meet that, some letter of closer ties showing that you have closer ties to Dubai than to South Africa. So for a pilot, he's very seldom in the country. He's only in Dubai 3 nights of a week because he's flying to Europe and America. He's never in South Africa, but he's not adequate days in Dubai. Then his employer will issue a letter and say that he always returns back to his habitual home and his wife is in that house, and that is the closer tie they have. And then the last one is that you must have an tax number or EID number. Now, very interesting. Remember, South Africa is very unique, and it's because of the old apartheid system that South Africans with an ID number could vote, but there were people who did not have an ID number, was not allowed to vote, but by law they had to pay tax. We therefore got a tax number that had no race indicator. So in most other countries, your identification number is also your tax number. In the US, your social security number is your tax number. And in the UK, it's your national insurance number. And in the Emirates, the ID number on your EID, E stands for Emirates ID, little smart card. It has 3 digits, your year of birth, and then a random 6 numbers. That is your tax number. So if you meet all of those requirements, okay, you then have a domicile. Now, why is that important? There are people at the moment that can buy property in the United Arab Emirates. Then they hold the property and they have a visa in their passport, but they don't have an EID. The reason for that is they can enter and exit Dubai or UAE without any restrictions, but they can't hold a employment and they can't have a bank account. So their way of calling your domicile then creates you the right to have a bank account. So the last thing that they then ask, last 2 things they then ask for your domicile certificate is they need a 6 months bank statement to show that your credit rating is good. They're very important for them. And the last one is they must have a letter from your employer to say you've been employed for more than 183 days. And then you're tax domiciled. And the minute you're tax domiciled, we're now into that test of our resident rules, our definition of resident. And if the tiebreakers now favor United Arab Emirates, you can exit South Africa. And how we do this, and this, Francois, is relatively applicable to most treaties, okay? So there's a specific order of tests. The first test and a tiebreaker is normally, for most treaties, you look at the country where you have your permanent home available to you. Important is it must be available. You need not own it. So now you have that lease agreement in Saudi, in United Arab Emirates. Now you have a place to stay, a permanent home. Okay, I'm going to quickly interrupt. In Qatar, you don't need all these other tests like a bank account and things like that. Qatar says the minute you have a lease agreement, you are tax resident in Qatar. But back to the UAE. Now, you are now deemed to be tax resident there because you have a permanent home available. But the treaty says you also now have a permanent home in South Africa, with the result that we now have a conflict. We go to the next tiebreaker. And you only need to meet one tiebreaker, but you need to follow the specific order. The next question is, if you then have a permanent home in both countries, then we look at your center of vital interest. Center of vital interest, or CVI, is an undefined combination of your closer ties financially, commercially, and personal ties. Okay, so when they look, and now we look at the OECD guidelines, they're a little bit stronger than the South African ones and a bit more modern. So the OECD says, but SARS accepts that we look at where you are employed and add more weight to new wealth created than old wealth. So even if your father is Harry Oppenheimer, but you are employed in the UAE and the wealth you created there is far less than your South African wealth. The fact that you're employed there by a non-South African employer adds more weight. So your economic interest or center is there where you choose to earn your own wealth, not inherit wealth. Secondly, your family ties. So if your wife and children are with you in Dubai, your center of vital interest, just because of your employment and the fact that your wife and children are with you, now you are in the second tiebreaker test deemed to be solely tax resident. It's very strong, deemed to be solely tax resident in Dubai. But now let's go again to my pilot clients. They have a problem because most of them, because they travel to South Africa that often, especially the Etihad one, where South Africa is a very important route to them. For Emirates, it's also, but the Emirates have so many routes that most pilots very seldom come back to South Africa. But the Etihad pilots are in South Africa every second week. They have a problem because now their children and their wives prefer to stay in South Africa, and they are staying by themselves in that little apartment that the Sheikh gave them, or if they're very senior pilot, they have the 7-bedroom home, 7 bathrooms, and they call it a villa. And so now we can't make them tax resident in either country because there's this conflict. Financial interest is Etihad, as in place of employment. His wife and children, South Africa, so his family ties to South Africa. The next test is then, and now it breaks, and now it looks at you as a single taxpayer. Now we ignore your wife, and it looks at your habitual home. Your habitual home, in terms of OECD rules, because South Africa is totally silent on what is an habitual home, and it's not your primary residence, okay? Your habitual home, the OECD always said, it is the home where you will spend most nights of a tax year or most nights after your shifts. Recently, and they're in a comment phase, they're now saying, this habitual home, we can't really look at 1 year. We have to now look at a 5-year cycle, okay? So in a 5-year cycle, where did you go and spend more nights than at any other place? And the example they give, and I think that explains to us what's an habitual home. Someone who works on an oil rig, he spends 4 weeks non-stop on the oil rig. Then he goes home 2 weeks to his wife in South Africa. He spends more time on the oil rig, but his shift that he goes home to after is not every night when he clocks out. His shift when he goes home is his 4 weeks on, 2 weeks off. So for that person, his habitual home is rather the 2 weeks in South Africa. So can you see that they're now not just looking at the number of nights in a tax year? They're looking on a 5-year cycle. You may have a 4-year employment contract and you're coming back to South Africa, or you're going home to your wife in South Africa. So your habitual home is South Africa. But back to my pilots, he goes home after every flight and his employer issues a letter to say his closer ties are to United Arab Emirates because he goes home and they pay him to always go home to Abu Dhabi if he's an Etihad pilot, because they fly on what they call the hub basis. The hub basis is all their flights leave United Arab Emirates and it always lands in another country. Okay, so it's like a little star. Therefore, their habitual home is South Africa. It's not South Africa where the wife is. His habitual home is where he goes home after he clocks out from the airport, and that is his Abu Dhabi home. Now, that's very important because that is normally the test where most South Africans in United Arab Emirates will claim sole tax residency in the UAE, because 80% of the people that I've met have homes in South Africa. One of the things that, if you want to ask me, what must they now do to become tax resident in the UAE, is if you have a home in South Africa available to you, rent it out, long-term rent, not to a family member, or if it's a family member, at arm's length. Because the minute you have a formal rental agreement in place, then that property is not available to you. So many people say, no, I just gave my parents the right to stay there. Do you remember we have a South African law that says any contract dealing with immovable property, including rental contracts, need to be in writing. So please keep to our laws, make it a formal rental agreement. And I know it's painful, you're going to pay tax in South Africa, but remember now you're paying tax on source only. Why do you worry that your parents are paying you market-related rental income? So very important. I'm just going to summarize. 3 tests. First one is where your permanent home is. If you rent out your South African home, long-term basis, arm's length to a third party, or arm's length to a family member, it is not available to you. Then on the first tiebreaker, United Arab Emirates win. Or so would England win, if it was England that you tested. Second test, center of vital interest, combination of where you're creating new wealth, where your employment is, and then where your wife and family is. Third test is habitual home. If none of those work, in most cases, the fourth test is then nationality. And being in the United Arab Emirates, you can then come back default to South Africa. If you're in Australia, America, and you have nationality in those countries, then obviously that would win. I just want to quickly interrupt you and go back to that center of vital interest. We had that interesting court case last year. Now the name escapes me, Francois, which said that the guy was tax resident in South Africa that came in from America, I think, because he was employed in South Africa before he was sent out. So if SARS keeps to that tax case, although it was not a high court, it could be that if you are working in the UAE and you're seconded by a South African company, that SARS could say, although you're employed in the United Arab Emirates, your center of vital interest, financial interest, okay, or economic interest is South Africa because you were employed here and seconded. But there are very few South Africans that are seconded to United Arab Emirates. The reason for that is that SARS changed the laws on our pension funds. So companies now prefer to terminate service in South Africa, then transfer that employee as a new employee to the United Arab Emirates.
Let me jump into the questions quickly. So there was quite a few. Something that came up from a financial advisor point of view is that, what are the questions we should be asking our clients, or what are the information that we should be aware of? At least when a client tells us, listen, we are considering going there, or I already have a client that's been living in Australia for the last 5 years, etc. What are the kind of questions they should ask to get these people to realize that they need to do something?
Okay, so the first one, where I normally get a lot of flack, okay, deals with endowments or sinking funds with or without life cover, okay, that is held offshore. So I'm not talking those that are South African insurers with offshore products. I'm talking about they have a Friends Provident Society endowment.
Yes.
Okay, I need that information. I need to know what was the base cost, historical value in dollars, and I need to know the value now in dollars. That is a foreign policy and is subject to capital gains tax.
Okay, so
Financial advisors keep on telling me it's tax-free. It's tax-free if it's a South African product.
Yes.
Okay, a foreign product is subject to capital gains tax. The other part is if it's a discretionary portfolio, I don't know if that's the word that everybody uses, but you have like unit trusts and there's a bit of bonds and shares and all these different things. I need the base currency report. Okay, so a lot of the fund managers or asset managers gives us a report in pounds, but there's Swiss francs and there's American dollars and there's Japanese yen and everything in there. Okay,
yes,
I need line item by line item in its base currency, because the calculation of capital gains is if it's a yen investment, it's the yen cost to the yen market value. Okay, and then that yen gain is converted to rand. I ignore, and we have to, for tax filing in South Africa, ignore that report. It's very nice to have that report for the client in pounds because he may have chosen pounds as his reporting currency.
yes.
But tax is paid on the base currency or transactional currency. The other important thing is that I need, and I think you alluded to it when we spoke about properties. And yeah, it's not so much the financial advisors. They're normally aware of it, but their clients are reluctant to give them that information. I need worldwide portfolio, not just your South African portfolio, because South Africans feel, but I bought that offshore endowment or the French Provident, if I can use a brand name. I bought that from my tax exempt salary in Saudi, therefore I'm not going to pay tax in South Africa. Unfortunately, it doesn't work like that. Okay, so we really need to have a worldwide balance sheet. One of the other things that we also have to look at is if the person is doing tax immigration with the view that he wants to formally immigrate, and I'll get to now why some clients want to still formally immigrate, then we have to look at the South African portfolio and decide, and yeah, unfortunately, I'm not friendly to my colleagues in the industry. If my client is, for example, leaving for England or has left for England, my advice, purely from a tax perspective, sell all the assets that are liquid and re-portfolio or reorganize the portfolio. The reason for that is South Africa is going to take the capital gains tax on the deemed disposal, the notional, the unrealized gain. Unfortunately, the UK
does not give you a step up in base cost. So if that share, if you had Naspers shares, I just had it with a client now who now sold these Naspers as part of their restructuring. His UK guy said to him, now you're paying tax on the value of your shares, and I think it's the 97 value. He was one of those who still got shares because of the bouquet of DSTV he had at those days. So he's paying tax on close to 180 million rand in the UK. And the reason is the UK ignores the fact that when he immigrated from South Africa 2 years back, he paid tax on 145 million rand. He's very upset because he's paying 10% there. He paid in South Africa 18%. It's not in the same tax year, so he cannot claim the South African taxes paid as a credit in the UK. He should have sold all his Naspers shares those days.
Yeah, so they use the original base cost still, like when he acquired the shares in the first place.
And to explain why they do that is if you leave the UK, they have no exit tax like us. Okay. So when you leave the UK, you do not pay capital gains tax on the value of your discretionary portfolio.
All right, cool. So next question, I'm going to play you the question.
Okay.
Can you hear how clearly we can hear? It's from Kobus Klein. So Kobus was asking about trustees. And so let me play that for you, and then we can answer. I'll also give a bit more background after I've played the question.
Good evening, Francois. It's Kobus Klein. Please ask Hugo if expat or person wanted to do financial immigration is a trustee of a trust and not a beneficiary of a trust, if that impacts on their financial and tax situation and the immigration they want to go into. Thank you.
All right, so let me just some of the additional information I can tell you. So as you heard, that this person is only the trustee on two trusts, but they are not, and there are other trustees on these trusts as well, but they're not a beneficiary of the trust. So he's already an expat in Dubai, and now he wants to formally immigrate. Will there be an impact on that situation? So if he does formally immigrate, can he still be a trustee on the trust? Or would there be other things that we need to consider that we're maybe not thinking of at the moment?
First question is, when most people tax immigrate to Dubai, the South African trusts, the local trust, remains tax resident in South Africa. And we do not pay exit tax within that trust, okay? The reason for that is it's very difficult within the Reserve Bank rules to move that trust abroad. So for formal immigration, so we have a tax issue, because the trust is still effectively managed in South Africa and it's registered with our master, he can stay on as a trustee. Absolutely no problem. The Reserve Bank, however, says, if you now proceed and you formally immigrate and you now leave our banking system as a resident for exchange control purposes, then the majority of trustees in that South African trust must be South Africans. So the bigger issue is exchange control. So people who tax immigrate only to United Arab Emirates, they can remain as trustees, no problem, because the trust normally remains tax resident in South Africa. For people who formally immigrate, doesn't matter to which country, they must then make sure that they appoint either a corporate trustee or the majority of trustees are South African. I want to extend that a little bit to the UK, US, and Australia. If you are going to those countries, whether you tax immigrate or not, purely because you have a tax number in Australia, and because you are a trustee of a foreign trust, because remember, for them, a South African trust is a foreign trust. That trust is a deemed taxpayer. It's not necessarily effectively managed or tax resident. It needs a tax number. Then in United States, United Kingdom, and Australia. Very important. So for my clients moving to those three countries, unfortunately, you must do what a trust was intended for, hand over control and interest, whether you're a trustee and beneficiary or just a trustee. Please remove yourself if you go to those countries. If you formally immigrate, speak to a corporate trustee or get an independent and a majority of independents in South Africa to run the trust for you. Also important is if that trust remains tax resident and you in the United Arab Emirates, if your children are the beneficiaries, they have normally followed your tax status. So they have tax immigrated as well, although they have no tax number at that stage. But if you then distribute a capital gain to them, SARS policy, although we don't like it and we don't agree with them, the current policy is the capital gains tax is then flat 36% because the conduit principle fails for capital gains tax.
So, but does that mean that that's only for minor children, right?
Yeah.
Yeah. So if they're already like 18 or older, then that would not apply. That only applies to if you've still got young children.
Very interesting.
Follow.
I'm busy with a court case. We're probably heading for court. SARS also knows the Sharia law rules and say, that child the daughter living with your South African client in the United Arab Emirates, she is 24 years old, and she, in terms of Sharia law, is still a minor because ladies only turn majority at the age of 26. Therefore, we will treat her because remember, the treaty is stronger than the South African law. So in terms of their tax residency rules, she follows that of her parents. She's a daughter, female, so it's very, very sexist, but unfortunately that's their rules, stands stronger than the South African rules. Therefore, she is deemed to be a minor. Also quite interesting is that in those Sharia law countries, the definition spouse does not include an unmarried person because they're very strict in that. So sometimes we have a benefit that we don't have a connected party. So in South African law, your spouse living with you, unmarried in terms of matrimonial law, is a connected person because of the definition spouse in South Africa. If you then live in a Sharia compliant country, then that may not be.
Oh, that is, I learned something new again. It just shows you that there is so many things that must be considered, and there is no one answer that we can give people and say this is what you should do. I guess the correct advice would be like, listen, get in contact with a specialist like Hugo, and get the right advice for your specific situation or for your client's specific situation, because there is no one. If you're in Dubai, you do this. If you're in Australia, you do this. There are just too many variables in this. Then another question I've got here is from Russell Ho. He asked that about young professionals, if they work abroad or they want to work abroad, and what sort of, is there something that they need to think about and do before they go? Or even if they're already there, obviously I think we've covered much of that. When you're in that country, you need to find out. But if they are planning to go, what are the first steps that they should maybe take?
I want to change it to young, big spinners, big earners, whether they're professional or whether they are tradesmen, I don't care. What is more important is leave the South African tax system as quick as possible before you build up worldwide assets. Because the longer you stay tax resident in South Africa, earning that big income outside, you are paying taxes in the foreign country, but there's a credit system back to South Africa. But when you die, you may be ordinarily resident and you're going to pay a state duty in South Africa. Or when you then go into a country and you then are forced to tax immigrate, because sometimes tax immigration is a consequence, you have no choice about it. Okay. Then, for example, they sting you because you did not tax immigrate early enough in your life. So I must be honest with you, in the IT industry, if someone comes to me and he's working for one of these new IT companies, I know he has a VDP and we're going to probably tax immigrate him, but way back to 2004, 2006 when he left school and went to work in America. Because the reason is that he may not be totally American because he's only on a green card system, so he's not a national, but America already taxed him. Okay. Now South Africa says, you remain ordinarily resident in South Africa, although the treaty says you are American tax resident. And we must remember that we now, with America, have a different treaty dealing with estate duty or death duties, okay? Which now means because you're ordinarily resident in South Africa, you are subject to South African estate duty, plus you are subject to American FET or federal estate tax. And that's an untenable situation to be in, because the one is 40%, the other one is 20%. The one will not give you credit for the taxes paid in the other country because the treaty is very old. I think it comes from 1953. And in the majority of cases, it helps, but there are certain cases where it just does not help. One of the examples is in America, if you hold a green card, your wife does not hold a green card. When you bequeath to her, there is no spousal rollover in America. In South Africa, ordinary residence test, there is spousal rollover. So your wife is going to pay estate duty when she dies or the last spouse dying. America is going to collect tax again at that stage. So very, very important. For my young professionals, you are not disloyal to the country. You're not giving up your passport. You're not giving up your right to return to South Africa. Even if you formally immigrate, you only undertake not to come back for 5 years. And if you come back and you're a so-called failed immigrant, it's not the end of the world. What does a failed immigrant mean? It means you come back, you tell the Reserve Bank, undo my blocked account. The Reserve Bank then has the right to say, you were outside South Africa for 3 years, you're a couple, so you could have taken 60 million rand out of South Africa in that 3 years. So you took out of South Africa because your father was very rich, you took 100 million out, but you now must bring back 40 million. I have only seen the Reserve Bank do that twice in my career since 1993. Okay, so if you want to formally immigrate, to make sure that you break the ordinary, so you're now showing no intention to come back to South Africa, do that. For those very wealthy professionals, formal immigration may be a way to show that your intention is not to come back. Because tax treaty, look at the Dubai people, they are ordinarily resident in South Africa, but treaty resident in Dubai. Because they're treaty resident in Dubai, South Africa can't tax them on income. But boy, if they die, South Africa is going to grab them for state duty. So young professionals, make sure you get out of our tax system completely. For you, it's easy to formally immigrate because you normally have no bank account or very little money, and there's no big capital gains tax. So in short, whether you are, and it also deals with, I had an example now when I was in Dubai, someone who worked for Denel left this country as a very desperate South African because lost his job at Denel. He then entered Dubai, and you won't believe they also have a defense force or a defense industry, and he's making big money in the UAE. And we're now going to backdate his tax immigration, and we're going to do a VDP back to 2009 because then he had nothing. And he's built up a substantial balance sheet outside of South Africa because of foreign income, but South Africa tax that.
And I'm just sitting here thinking now, it would make sense for that person, because I think the mistake they often make is that I've got nothing in South Africa. I now I maybe have a year or two of experience. I now go overseas and I go work there and I'll build up a life there. But then again, this whole thing about like the exit tax on your worldwide assets. I think they disregard when they think about and that's why I say it's such good advice to say, well, while you have nothing in South Africa or you haven't built up substantial assets, just try and formally immigrate, try and tax, make sure that you get out, because that will be the cheapest way to obviously do that. Although that won't be possible for everybody, but for those young professionals that want to go, and as you say, it doesn't matter what they do. It doesn't really have to be that you have to be an accountant or a lawyer or somebody that's now moving. It's just anybody that's going to work overseas. If you're still young and you can do that, then just get, just formally immigrate as soon as possible.
Yeah. The other thing I want to also then add, and now I'm saying my young immigrants coming from wealthy families, and now wealthy is a very interesting number, okay? Because if you want 4 children, then if your parents got 20 million, it's not too much of a problem because you're not going to pay a state duty on your portion. But if you're the only child and your parents have 12 million, okay, your 12 million after their estate duty is going to be more than 7 million. So you are subject to South African estate duty.
Yes.
Unless you formally immigrate, which then allows you to take that assets out before you die. But the point I want to make, even if you have zero assets left in South Africa, please have a South African will, because there could be money that you inherit or assets you inherit from your parents. And if you don't have your own will, then you are dying interstate. And I recently had that in a case where a client died in a freak accident in Saudi, and he was about 4 months predeceased by both his parents who died in a car accident. Okay, they died interstate. He was the only child, and he died interstate, and he died in a Sharia compliant country, and he was not married to his wife. Okay, so can you guys see the problems we're sitting with? So furthermore, if you're then in a Sharia compliant country, go and register a non-Muslim will to make sure that your female beneficiaries or legatees can get their due inheritance.
That's important. Last question from the listeners is from Mark. So Mark asked, he's got a client that works in Zambia and earns about 2 million. He has a living annuity and a unit trust in South Africa, and he's not sure if he is going to come back. He's going to retire in about 3 years' time, and he's not sure if he's going to come back to South Africa. So we haven't really spoken about many of the African countries, etc., and how we deal with that. But, is there things that he should consider in terms of that?
Zambia is a very interesting country. So the treaty we have with Zambia is with Northern Bechuana land. That's how old it is. So the layout is not even OECD template. It is just very complex. So if we compare Zambia with Botswana, in Botswana, to claim the treaty benefits, you just need to be tax resident in Botswana, which means you must have a rental agreement, be in the country 183 days, and be employed by a Botswana company. Then you're resident. In Zambia, you must be ordinarily resident before you can use that treaty. So although they now also have the physical presence test, and they have a rule that if you're employed by a Zambian company, then there must be taxes paid to Zambian government. It's very difficult to use that treaty. So to come back to that very interesting situation, that person could not claim his retirement annuities in South Africa, assuming he had no income, because he obviously had a tax exemption. He had no taxable income, I assume. Very interesting is in terms of the new rules, that amount of retirement annuity that he could not claim, the minute he comes back into South Africa and he starts paying tax in South Africa, sorry, before he comes back, so 1 March when we go into the capped millions era, then that arrear contributions within the annual limits may then be deducted. So his R1 million for the first 2 years could become 1.24 million, roughly that amount, okay? So it's very interesting that that person had the right to now claw back all his old contributions. That was not previously claimed. But one of the questions we now have to ask is, say, okay, he cannot tax immigrate, but nothing stops him to formally immigrate. Because by formal immigration, he can now extract that retirement annuities from South Africa, and the lump sum is taxed, only 25,000 exempt, but he can then claim all the contributions he made that was not deducted from tax, he can now claim as a deduction. So maybe it's attractive for him to take that amount out. Why is it attractive? And now I'm going to plan very holistic, and we can actually have a different session on this front shop. But SARS has changed Section 10C, dealing with pension funds. So in the old days, if I had a South African retirement fund that paid out, and I worked 10 years abroad, 20 years in South Africa, a third was tax exempt. Now, because of new rules, it is 100% taxed in South Africa. They ignore the years that I worked outside of South Africa. So it's sad what it caused to our industry. So me as tax advisor must tell that client, even if you intend coming back, it is better to have a Zambian pension fund, although it's a weak currency as well, or do an international pension fund. Stop paying to the South African fund, because the minute you retire in South Africa, the full proceeds, although paid from a tax exempt income, will be taxed in South Africa. That's one angle. The other angle is, if you don't know where you're going and you know you're probably not going to come back, you can continue contributing. Because if you, for example, and I use just 1 or 2 examples that I know of, if you go to New Zealand and you retire to New Zealand, they allow retirees in. Then the treaty with South Africa and New Zealand says that retirement annuity may not be taxed in South Africa, even if you contributed from a South African source. The treaty just says retirement annuities or living annuities funded from RAs may not be taxed in South Africa, only New Zealand may tax. New Zealand from their side says for the first 4 years, we're not going to tax you. Israel, first 10 years, okay? UK will tax you from day 1, but they'll only tax 95% and South Africa cannot tax. And now comes the beautiful exchange control rule. I get so frustrated when people come to me and they say, I want to take my retirement annuity into a living annuity, and I now need to formally immigrate to get my money out. There's a thing, and if there's one thing everybody remembers from today, Circular 4 of 2014, Circular 4 of 2014, withdrawn but now taken up in the guidelines of the Reserve Bank. When any person has a foreign FICA address, a foreign bank account, his annual, monthly, quarterly retirement funds, be it living annuity or pension fund, can be paid directly to him in the foreign country without impacting his annual 1 million single discretionary allowance and without affecting his 10 million allowance. So for people over 55 years, you can take out 10 million on a tax clearance, 1 million on a single discretionary allowance, and your entire annual income from retirement funds. If you are then in a country that is a treaty country which does not allow South Africa to tax, there's a process that we can get your pay-as-you-earn switched off in South Africa. So it's a very complex thing. This client doesn't know where he's going. He just knows he's probably not going to come back. I would then consider making it paid up. But remember, you probably know, Francois, old products have a penalty clause, so I can't advise on that.
Yes.
I just say to them, do take into account that you're not getting an immediate tax benefit right now. But on the other hand, rather have some retirement planning than no retirement planning. Or if you're in a country where there is no, like Angola, there is just no industry for retirement funds, and it's very difficult to get the money out of Angola, then maybe keep on paying your South African RAs.
Then I've got two more questions I want to ask, and then we'll wrap up. So there was another person that this was somebody that's working in Saudi Arabia. He's been working full-time outside of South Africa for almost 10 years, but also prior to that, he's always complied to the 183 days rule. And he says that there is a DTA between South Africa and Saudi, but they pay no tax there, so he's not sure if that will be of any help. And he's got 2 properties in South Africa, and his wife is still in South Africa. They are considering living outside South Africa, but he needs sort of the best solution for his tax liabilities because of the new tax law that's coming about the 1st of March. So is there any advice we can give them?
Yeah, get your wife out of South Africa quickly. She's not going to like it, but unfortunately she has to. So the Saudi treaty, unlike the United Arab Treaty, you must be paying tax on a worldwide basis before you can claim the benefits in the treaty. So it's very difficult to tax immigrate on the Saudi treaty. Okay, very, very difficult. I have had people where I was able to do that, but then you have to do it on what we call ordinary residence test. So I had to show the ability not to come back. So they really had to go and buy an investor visa. They then had to cash out their RAs, which meant they had to formally immigrate. They then had to move all their asset that was in personal name that they did not want to take out of South Africa into a family trust. That was typically the farm, the inheritance assets, which are sentimental. Having formally immigrated from South Africa, they were entitled to do a Mauritian trust. And the new company is called an authorized company in Mauritius. Mauritius says there's the old type 2 companies, which were tax exempt. If you now register that in Mauritius and you have your bank account in Mauritius, but your board of directors, effective management is outside of Mauritius, it's so-called authorized company. So we then moved that authorized company to South Africa, because remember, that farm is always going to be subject to capital gains tax in South Africa. And we then moved that to South Africa. We're going to pay capital gains tax. At least we're paying 22.4% current rates compared to 36% in the trust. And secondly, the dividends tax to Mauritius when we one day extract is only 5%. So 22 plus 5% on a farm, far less than 36% in the South African trust. So it was easy to show that he has no ordinarily resident status in South Africa, because he himself holds nothing via South African structures. Everything is held via offshore structures, and we physically took everything out of South Africa. Very sad for our country, very wealthy couple, but that was the way to get them out. But while coming back to this client, while his wife is in South Africa, there is no ways I can say you're ordinarily not resident in South Africa while your wife is in South Africa. Surely you're coming back to South Africa. So I am very sorry for the people in Saudi. The capped exemption is going to be their future. They have to look at that. I do know that there's a big aggression to sell pension funds to those people and say your employer must contribute a huge amount into a foreign pension fund, which is then, they argue, not taxable in South Africa. I'm still challenging everybody and say, bring me that tax opinion, because current law says if your employer pays a retirement benefit on your behalf as a non-contributory fund, that is added to your salary as a fringe benefit. And in the next session, we can speak about the problems that South African employers face with all the international structures, because our tax law was not written for international structures. So there may be indeed a retirement fund, if I can call it that, that escapes the South African fringe benefit rules. But by default, I must warn the client, our current law intends or will try to tax you on the fringe benefit of a contribution to a pension fund or medical aid fund on your behalf.
The last question. We often have people that also apply for foreign investment allowance certificates. So if they want to take money offshore, the 10 million. And I mean, from a practicality point of view, sometimes people want to apply for, let's say, 5 million, certificate, but they don't have that money yet. I know that you don't. Once you've got that, let's say if SARS does issue the certificate for 5 million and it's valid for 12 months, that you don't have to take out the 5 million all at once. You can take it out.
Yeah.
But you do have, there's some interesting things that's happening where people are taking advantage of certain arbitrages and things on, between like cryptocurrency exchanges and all kinds of stuff. And I know they can use their first million discretionary to get money out and that, but if they have to pay money to a USD bank account, a USD-based bank account, for them to get it out, is there a way for them to actually apply for such a certificate to say, well, listen, so I want the maximum, but they can't prove that they've got that. But it's money that they actually, that's going out and coming back and going out and coming back. It's the same money actually, and all they do is profit from that arbitrage.
So first of all, I've been told that people achieve that by showing to SARS their business model, and based on the business model, they could justify source. I'm very glad for them. But they've also then, if they disclose that business model to SARS, have asked SARS to tax them, which correctly so, because they are trading in financial derivatives. So they're going to pay income tax on that gains. It's not capital gains tax. So yes, that is a problem. Secondly, I am now dealing with probably about 12 cases backdated to 2015, where the American IRS is telling South Africa that the following person has made transfers into a cryptocurrency. So they don't know what you did inside. They can't see that, I'm told. But they are telling the South African government who are transferring money in. Furthermore, we must remember Luno, to use a brand name, is a South African Naspers company. So they are probably reporting everything to SARS. So before we get to the exchange control rules, do note that if you are doing this arbitrage, you are in to be taxed. Yes. Secondly, unfortunately, for those guys who don't have that money in their bank account right now, it is a problem. I have yesterday, shock and horror, seen where people are using ID and tax numbers of friends that, and not being derogative, it's really people that took out of townships and university campuses, okay? It's 18 years and 3 months old, and they're taking R1 million out on their names. How can you do that? SARS knows about that. You are registering someone for tax, very easy, because you don't have to show income to get a tax number. But SARS get that information that R1 million is going out. So now you're actually opening yourself if you are advancing that money to that person. If you don't have a loan agreement, what's going to stop you when SARS comes and says that was a donation? Okay, so that's a huge problem. Secondly, there's a huge exchange control problem for me on this people doing the arbitrage using other people's ID numbers. It is an exchange control contravention that leads to forfeiture, not penalty, forfeiture, to combine two South Africans' money in a joint account outside South Africa unless they are husband and wife. If you are putting Mr. ABC's money, that R1 million, into your Luno account or your cryptocurrency account in America, okay, you are contravening exchange control, and the penalty is forfeiture. So although South Africa and Exchange Control Reserve Bank says current crypto is not a currency, we're not controlling it, we still have basic exchange control rules that people have to comply with.
Thank you so much.
I've just hurt the crypto industry terribly, but unfortunately, no. I'm very conservative in my approach.
Me too. So I'm so glad that you brought that up, because we've spoken, obviously we all have friends that sort of, especially at the height of Bitcoin and all these things before they crashed a little bit, and then now I see it's back to about 120 or whatever. We do have those friends that say, oh, we do this and this and we make this, and then I say, but whoa, there is a tax consequence here, and I didn't even think about the exchange control, to be honest with you. So that is so important that we mention that, because people need to know about these things, and specifically us as financial advisors. I say us, I'm not a financial advisor myself, but I work with them. And they all have clients that do these things, and that they tell them, listen, I'm not going to invest the money through you because I'm doing this and this. So we become aware of it. And I think we have a responsibility and a duty to actually tell them that, listen, there are certain things you need to consider. The process might be easy, but there are certain consequences that you are not considering because of this. And you need to educate.
Yeah, the excuses they use. So I gave them this summary in email yesterday. This morning at 6:10 as I woke up, first email on my phone was them coming back to, oh, no, not a problem. The Bitcoin account in America is not in my personal name. It's in my company's name. I had a heart attack right there. We have a South African company with a foreign asset, okay? without permission from the Reserve Bank. Because although it's not a currency, it's a financial derivative. It's an asset in terms of exchange control.
Yes, absolutely.
They have a foreign bank account or derivative account without South African Reserve Bank approval. Forfeiture. It's not penalties, it's forfeiture.
In
and
other
their
words,
clients,
they
this
come
money is lying in there, is going to get, the Reserve Bank can claim for, I don't know if they'll do it, but I have to warn my client, that is the rules on the Reserve Bank. It's forfeiture.
Yes. Hugo, wow, this was an amazing session. It flew by. We definitely need to chat off air to see what other sort of, if we can maybe do a little series and focus just on specific things. But thank you so much for your time. Sure, you were so selfless in doing this. So I really appreciate it, and I wish you well. And
last thing, if people want to follow me, I think the easiest is my Twitter name is Wegkaner, W-E-G, like Weg, away, Kaner, given to me by either Lorica Raag or Sonia Harold. I can't remember. I was lecturing in London many years back. So like certain Freddie Mercury, I were at Wembley. He had 12,000 people. I had 12 people in attendance. But they then said I'm the Wegkaner's best friend, meaning the South Africans in London, at that Ukasi festivals in London. So my biofline became Wegkaner's best friend, and now it's my Twitter name, Wegkaner, @Wegkaner. And I also have an email address, wegkaner@iafrica.com, and it's easy to get hold of me.
And
thanks, Francois. I really, really appreciate it.
It's a pleasure, man. And your website address, where can people get hold of you if they do want to get hold of you, apart from hugovansale.com, or then my brand name, taxmigration.com, without the E or the I, tax migration, because I help people coming in and I help people going out. Cool, that's awesome. Hugo, as I said, thank you very much. I appreciate your time.
Thanks a million.
And have a great day.
Thanks a million. You keep well. Bye-bye.
Thank you for listening to Propulsion. If you found this episode valuable, please subscribe and leave us a review on iTunes or your favorite podcasting platform. This will help us tremendously. For more about Propulsion and other valuable information, please visit our website at propulsion.co.za.